Hey everyone, welcome back to Corporate Decoder, the place where we dig through the nitty-gritty of corporate filings to find the real story. Today we are unwrapping the latest 10Q from Richmond Mutual Bancorporation, and let me tell you, there are some interesting numbers in here that might just paint a picture of where this bank is heading. Before we dive in, if you appreciate getting these straight insights, make sure you are subscribed, and if you want to chat about these filings and connect with other finance enthusiasts, join our Discord community. The link is in the description below. Okay, let's talk about Richmond Mutual Bancorporation and its latest financial snapshot from September 2025. They filed their quarterly report, and it shows us how the company has been doing, especially in its banking operations through First Bank Richmond. First off, the company describes itself as a non-accelerated filer and a smaller reporting company. This basically means they are not a huge corporation and they have a bit more flexibility with some of the reporting rules. It also suggests their overall size and revenue are on the smaller side compared to the big players in the financial world. Looking at the balance sheet at the end of September 2025, they had about $1.5 billion in total assets. That is a slight increase from the end of 2024. What is driving this? Well, their loans and leases are up a bit and they're holding more cash. But they also sold off some investment securities, which brought that number down. Their investment securities, which they classify as available for sale, have seen a dip. They stood at around $250 million at the end of September 2025, down from about $258 million at the end of 2024. This decrease is mainly because they had some securities mature or got paid back, and they also sold some off. But they did get a boost from market conditions as lower interest rates actually made their investments worth a bit more on paper, offsetting some of that decline. They are using these funds to fuel loan growth, which is a common strategy to earn more. Now, the heart of any bank's business is its loans, and Richmond Mutual Bancorporation is no different. Their loans and leases, after setting aside money for potential losses, were about $1.2 billion. That is up slightly from the end of 2024. Big increases came from commercial real estate loans and multifamily property loans, showing a focus on business and property lending. However, construction loans saw a pretty big drop. When it comes to loan quality, they reported about $6.4 million in non-accrual loans at September 2025. That means these loans are not generating interest income as they are likely very late on payments. This is up from about $5.1 million at the end of 2024. The increase was mainly tied to one commercial real estate loan, though they mention it is largely guaranteed by the Small Business Administration, which is usually a good sign for recovery. Still, non-performing loans, which includes those 90 days past due or more, are around 0.90% of their total loans. While not alarmingly high, it is a slight increase from the previous year. To cover potential loan losses, they set aside about $16.4 million in their allowance for credit losses. This amount actually went up by about 3.6%. Why the increase? Primarily because they are growing loans in areas like commercial real estate and multifamily properties, which tend to have higher reserve requirements. Also, their economic forecasts are showing some concern about slower GDP growth and rising unemployment, leading them to be more cautious with their provisions. Management is keeping a close eye on the economy, specifically mentioning persistent inflation and slowing growth. They highlight their focus markets like Columbus, Ohio, and Indianapolis, Indiana, which are showing decent growth despite these national headwinds. They point to strong job creation and development projects in these areas. However, they also acknowledge challenges like inflation and housing affordability. This shows they are aware of the risks but are strategically positioned in areas they believe will perform well. Let's look at how the bank performed in terms of profit for the quarter ending September 2025. They reported a net income of $3.6 million. That is a nice jump of about 45% from the same period last year. Diluted earnings per share also improved significantly. This boost in profit was mainly driven by an increase in their net interest income, which is the difference between what they earn on loans and investments and what they pay out on deposits and borrowings. Their net interest income before accounting for potential credit losses really saw some impressive growth. For the third quarter of 2025, it was $11.3 million, up nearly 20% from the previous year. They attribute this to a better interest rate spread. Essentially, their loans and investments are earning more and their funding costs either stayed steady or slightly decreased. This improved profitability is a key takeaway from this report. Their net interest margin, a common measure of profitability for banks, also improved. It was 3.07% for the third quarter of 2025, up from 2.60% in the same quarter the year before. This increase is positive, suggesting they are earning more on their assets relative to their liabilities. They mentioned that the Federal Reserve's rate cuts late in 2024 helped lower their deposit costs, while asset yields remained strong. On the non-interest income side, things were a bit softer. It actually decreased slightly compared to the previous year. This was mainly because they made less money from selling loans, which can be a volatile income stream anyway. However, fees from servicing loans and other income streams like wealth management saw increases, which is a good sign of diversification. Their non-interest expenses, which are the costs of running the bank apart from interest payments, went up a little bit. Salaries and employee benefits saw a slight dip, which is interesting perhaps due to lower stock compensation costs. But they did have higher legal and professional fees, likely for external consulting and other services, and increased spending on data processing and software upgrades as they modernize. The amount they paid in income taxes went up, which is expected when profits rise. Their effective tax rate was about 15.2% for the quarter. Looking at the bigger picture, for the first 9 months of 2025, the company's net income was $8.2 million. That is an 18.3% increase compared to the same period in 2024. Diluted earnings per share also saw a solid jump. Like the quarterly results, this improvement was primarily driven by higher net interest income. On the funding side, their total deposits, which are the money customers entrust them with, grew by about 2.2% to $1.1 billion. They saw more customers putting money into time deposits like certificates of deposit, which is understandable as the bank is offering more competitive rates on these. However, they also saw a slight decrease in brokered deposits. Uninsured deposits, which are amounts above federal insurance limits, make up about 23.5% of their total deposits. Their borrowings, which mainly come from the Federal Home Loan Bank, decreased a bit. They've been strategically letting some of their more expensive borrowings mature, which is a smart move to manage costs. As for the company's equity, it reached about $140 million. This is up from about $133 million at the start of the year. The growth is thanks to their profits and also because the market value of some of their investments has improved due to lower interest rates, which positively impacts their accumulated other comprehensive loss. They did pay out dividends and repurchase some stock, which reduced equity, but the overall trend is positive. Overall, Richmond Mutual Bancorporation seems to be navigating the current economic landscape with some success. Their profitability, particularly net interest income, has improved, and they are strategically managing their loan portfolios and funding costs. The slight increase in non-accrual loans is something to keep an eye on, but it appears to be concentrated and manageable. Their capital position is strong, exceeding regulatory requirements. The company's focus on specific growth markets like Columbus and Indianapolis, combined with a conservative approach to lending and a proactive stance on economic forecasts, suggests a solid strategy. However, the ongoing economic uncertainties, including inflation and geopolitical risks, mean they must remain vigilant. So, what is my take? Richmond Mutual Bancorporation is showing resilience and smart management, particularly in a challenging economic climate. They are growing their loan portfolio in key strategic areas while also carefully managing their funding costs and reserves for potential losses. The improvement in their net interest margin is a significant positive indicator of their operational efficiency and their ability to capitalize on market conditions. While they are not a giant bank, their focused approach and solid financial performance are commendable. The slight increase in non-accrual loans warrants continued monitoring, but the overall picture is one of responsible growth and financial health. They are well positioned, but like all financial institutions, the broader economic outlook will continue to be a key factor. Alright, that is our breakdown of Richmond Mutual Bancorporation's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.